You've had a lot of leaders warning of potential pain ahead for markets, not everybody being downbeat. You get kind of these mixed views, especially when it comes to things like private credit. Right. Tell me what sticks for you and how you see the market outlook right now.
Yeah, I mean, we're still pretty bullish on the market outlook. I mean, we build what we call fortress balance sheet type portfolios, and we're building globally diversified portfolios, and we have a very healthy allocation right now to non-U.S. equities.
You do?
We do. And
coming off of last year?
Coming off of last year, even before last year. So over the past several years, we've been leaning in more to non-U.S. equities, given where the U.S. dollar was at. And so we had a very nice tailwind coming into the year. We've given some of that back here naturally over the past 2 trading sessions, but, we still believe in really buying the dip at this particular point and owning non-U.S. assets. We still like private credit. It's having a moment a little bit in the news, but we still like private assets, especially private credit and private equity for sure.
Going back to the non-U.S. assets, is it because of valuations? Is it because of fundamentals? A little bit of both?
It's a little bit of both. It's a little bit of everything, right? Okay. So if you think about what's really happened, the whole global economic order has really been turned on its head here over the past 12 months under the Trump administration. So if you think about what's really been happening, look at like German defense stocks, right? Europe is rearming, and these things are actually pulling the Europeans together. You're starting to see more coordinated investment within the European Union and places like that. So part of it's fundamentals, part of it is valuations, but we cannot ignore the currency effect, right? If we look at the administration's policies, a lot of these are anti-dollar policies,
right?
And we actually think that's a structural, secular headwind going forward. Even after this war ultimately wraps up, we still think there's going to be a lot of headwinds for the U.S. dollar going forward.
Is it part of it because you believe that there will be pressure on whoever comes in after Jay Powell at the Fed to keep rates low or to even cut rates?
I mean, certainly Kevin Warsh would like to be able to bring rates a little bit lower, but we all know, I think, if you've known him long enough,
he's not.
He's a hawk, right?
He is a hawk.
And so we actually think he's going to be a little bit resistant to wanting to take rates lower.
Yeah.
So, and then if you look at what's happening right now with the oil situation, this is inflationary. So we actually think that there's going to be upward pressure on inflation, and naturally rates are going to have to follow that.
And we were still dealing with inflation pressure
Absolutely.
and issues coming in. So in an environment like this, I mean, you and I were talking before we got going, I found it pretty remarkable considering what happened over the weekend. In most, go back to different market cycles, I would have expected a lot of selling, certainly in U.S. equities. I would have seen a little bit more of a spike, certainly in the energy markets. What does that tell you? Is it, some of the conversations we've been having is whether or not, Don, things are priced in already, or I don't know, what does it say to you that we believe this is a president that is going to do things that ultimately will relax markets back down?
I mean, potentially. I think there's a little bit more to the story.
Okay.
I think part of it is if we actually look at the global energy situation today, Carol, that we are less dependent on a relative basis, less dependent on oil from the Persian Gulf. Now, to be fair, still 1 out of 5 barrels still transits, the Strait of Hormuz.
Right.
So that's still a reality. But the Saudis, for example, they have a 750-mile pipeline that goes from east to west that runs to the Red Sea, right? So there's just one example. We have also had the shale boom in the United States. So there's been these other developments in energy markets that I think on a relative basis explain why we're not seeing $100 oil at the moment, given everything that's been happening in the Middle East. So I think that's part of it. I also think the administration, to be fair, they do not want this to be an endless war. They have every intention, in my opinion, to really wrap this up in the next 4 to 5 weeks.
We do have midterms just coming in.
We do have
months,
midterms,
and that will make a difference.
For sure.
So what exposure do you have to the U.S. market then? You sound, obviously you like non-U.S. assets. Yeah. So do you have any exposure to the U.S. market?
We absolutely do, right?
Okay.
So we're building globally diversified portfolios. Also on the equity side, we're going to be somewhere around 65% to 68% U.S.
Still.
So it's about a market weight. It depends on the strategy that we're running for clients.
Like non-U.S. assets for so long, we're so out of fashion, right?
That's
so that
true.
even though you're over, it's still,
And so, I mean, our non-U.S. equity exposure is around 30%, 32%, depending on the strategy.
Okay.
And so, which is actually really high. I mean, you talk to most wealth advisory firms, it's 10%, 12%, 15%. So we're easily 2 times the average wealth advisory firm's allocation.
What do you like in the U.S. markets? And again, I know you're doing different portfolios and so on and so forth, but the trade that, people have beaten up consistently over the last few years continues to be those big tech names.
Exactly.
And Mag 7, and yet there you see year after year, they outperform. Some folks say maybe that's going to be changing. How do you see it?
I think we'll still continue. I think we're going to continue to see the big hyperscalers do very well.
Yeah.
Right. So we still like those names. Some of the software names I think are certainly under stress going forward, given the onset of AI.
But is that an opportunity, or you don't want to touch that yet?
It could be an opportunity, right?
Okay.
I mean, at the end of the day, you have to look at, what do the earnings growth look like for these companies, right? What's their debt situation look like?
Right.
But at the end of the day, I mean, we really like the value play. So some of those names are starting to show up in sort of the value side of the portfolio. But for companies that have much higher quality earnings, I think that's where the hyperscalers and stuff like that, that can afford that heavy CapEx that they're making into their AI infrastructure at the moment. Yeah. Those companies remain interesting. And look, the reality is if you are too underweight the Mag 7, your tracking error relative to the market is going to be dramatic, and your clients are going to be asking you about that.
Over and over again,
so
right?
Absolutely. So you're going to want to pay close attention to that. But you do want to diversify beyond those names, Carol.
Right.
I mean, look at what's happening in small cap stocks.
Yeah.
I mean, so you definitely want to have exposure to those types of names as well.
Don, we just got about 30 seconds here. So you come to this event, you hear different conversations. Is there anything that you picked up that you're like, I hadn't been thinking about that?
I keep coming back to there's this big push, Carol, to make illiquid assets liquid.
Yeah.
And part of it's the private credit story at the moment. And obviously there's a push to put private equity and hedge funds and crypto into like 401k plans. And so that's something that I've been very cold to historically, but I'm at least entering into these conversations with an open mind, trying to understand where does this make sense? How can this help people better plan for their retirements and things like that? So I'm trying to keep an open mind, and this conference helped with that a little bit.